In honor of Friday the 13th, we thought we'd talk about things that scare investors. We're going to focus particularly on why the boogeyman that so many investors focus on may not be the one they actually need to worry about. It's Friday the 13th. We want to talk about scares and things that are frightening investors, and hopefully leave you with some things to think about that'll help you approach things in a more productive way. Specifically, we want to talk about the confusion that often exists for investors between volatility and risk. And I beg you to stick around because it's all going to crescendo into this story that was shared with me by a Jewish gentleman who grew up in Nazi Germany that completely shaped or reshaped how I thought about volatility versus risk and what is true risk. So stick around for that. I promise it'll be worth it. So let's begin with what is volatility and how does it differ from risk? Well, volatility, purely speaking, is just a temporary fluctuation in value. It could be to the upside, but again, the volatility that of course creates concern for investors is volatility to the downside. And that is completely understandable as the same part of your brain that gets triggered by mortal danger gets triggered by losing money. And so while it's completely natural, it isn't productive. Risk, on the other hand, is the permanent impairment of capital. It's gone, whether that's some shares of something you had to sell off that never come back, or literally just the depletion of how much money you have that cannot be replaced. And the confusion that exists between the two only really comes about, or is often comes about, because people have to liquidate during a bout of volatility to the downside. And therefore, they do have that risk. But without that arbitrary time frame, they really are two separate things. So how then do we keep them separate? And how do investors often, in the name of avoiding volatility, actually embrace more risk? I'll give you a few thoughts on that. The most common one, of course, is by taking way too conservative an allocation. And here, whether people are fully conscious of it or not, is what I believe plays on investors' minds. And having gone through this with literally now hundreds of clients, friends, family, and saying, correct me if I'm wrong, but is this really how you're thinking through this? I've come to believe that this is true for the vast majority of us and the vast majority of investors. And it's this: we're working under the knowledge that we're going to save, we're going to invest, and we're going to hope the market grows, and this money will grow over time. And then at some arbitrary point in the future, whether we cease to work or we've ceased to want to be a market participant, we're going to take whatever money we have amassed and put it into a shoebox and pray that by the time we have our last day, there's at least a few more dollars to pull out of that shoebox to do whatever it is that we need or want to do. And the fear of that shoebox running out is quite literally Americans' greatest fear. Depending on what study you want to look at, either 45 to almost 2/3 of Americans cite running out of money before they die as their number one fear in life, including being higher than death itself. So why is that not a productive mindset? Well, number one, you don't have to take your money out of production. You can keep it working. And the way, yes, if you're just taking a few bucks out of that shoebox every day, or that CD account, or that cash account, or that too conservative of an allocation given for the life that you want to lead, you're not likely to have a lot of volatility. And while you're not likely to have a lot of volatility, i.e. the temporary reduction in value, what you've actually embraced, whether you're fully conscious of it or not, is the permanent depletion in capital. It's no longer growing, and so every day for the rest of your life, your net worth is going to drop in value because it has no chance to grow, or it has no chance to grow with respect to an inflationary rate that's clicking along between 2 to 3%. So again, in a nutshell, yes, less volatility. The value of your shoebox and the money within it isn't going to vacillate a lot, but those drawdowns, those temporary drawdowns that you have now successfully avoided have turned into permanent drawdowns for the rest of your life. And in a world in where life expectancy is going up all the time and medical breakthroughs are happening, trying to guess when that day may come for you and hope that your plan and that shoebox is big enough is a place that, again, I've seen time and time again, and we've been able to relieve so many people of the fear, is one that they just don't want to, nor do they need to live with. So how do you go about avoiding it? Well, simply put, get that money to work. It doesn't mean it has to be in the stock market. It doesn't mean it has to be in any singular thing, but it should be these two things. Number one, something or a combination of some things most likely that produce enough income to mitigate most of what you need. So to whatever degree you do need to liquidate things, it's nominal, i.e. small. Or two, diversified, meaning things aren't acting the same. So yes, this part of your portfolio might be down, but you've got another part to pick on. And I would really do it in that order. We seek to try to get income right, number one. Of course, we're building diversified portfolios, but our hope is to have to sell little to nothing out of that portfolio. And now we can extend that longevity of the portfolio almost indefinitely, but certainly much, much further than those people who embrace cash, all bond allocations, annuities, God forbid. I promise you the story around my friend who shared again the investing insight given from his time during World War II. And it's this. You know, when I'll talk to people who are really, really frightened as investors, and they're just worried that this is going to crash the market or there's going to be another Great Depression, it's very theoretical. The fear is very, very real. But as my friend shared with me, they're not walking through all the way to what they're afraid of. If the meltdown, and if you think back to 2008 and the headlines around, everybody's going to go bankrupt, you could have been in just about anything. Your bond allocation, if a company goes bankrupt, is worthless just as much as the stock is, for all intents and purposes. If you're in cash and the FDIC insurance fails, which it does in this so-called theoretical Armageddon situation, your cash isn't worth much. And this is what he shared with me. So he grew up, a Jewish gentleman in Nazi Germany, and he said, look, investing is completely counterintuitive. That's true in a whole bunch of ways, but he was bringing it up again in this volatility and risk. And he goes, when people are afraid of something happening, they run into cash, they run into gold, they run into bonds. And he wasn't saying you should never have some of those things, but he goes, and they avoid stocks. But he goes, as someone who grew up in Nazi Germany, who was chased through the woods as a young boy by the SS troops, what I came to understand is this. The cash that you could have had after the war was worthless. They issued new currency. The bonds and all the debt got wiped out. If you had gold, it got seized by the Nazi Germans, or as he said, it was really heavy to try, or would have been really heavy to try to run through the woods with. So again, theory meets practicality, which this gentleman unfortunately had to live. But he said, if you had a share of Daimler-Benz, that was still worth something after the war, and it was pretty light to put up, in your theoretical pocket to fold that certificate up and put in the back of your pants. That times have changed, there's some different things going on, but I think that truth exists, which is some of the ways that we innately think about things aren't necessarily played out to their total conclusion, how things would actually be. And in some ways, trying to seek an avoidance of volatility leads to far more risk, that permanent impairment of capital, that running out of money before you pass on, that so many people seek to avoid. I'll leave you with this quote by Jason Zweig, who said, "The single greatest challenge you face as an investor is handling the truth about yourself." That's not just true for you, it's true for me. It's a journey best taken together. That's why I'm grateful for my teammates here. And again, grateful for so many of you who invited us to walk on that journey with you as well. Hope you've found some help from this. Happy to walk through these concepts more with you anytime. Hope you have a great weekend.